Good morning, everybody, and welcome to our very first Elite Traders Club weekly analysis session for 2016. It's Monday, the 11th of January. Hopefully, everybody's had a relaxing break over the course of the Christmas period, whatever you've done with your families or by yourselves with holidays, etc. Hopefully, you've had a chance to pause, reflect a little bit on what happened during the course of 2015. On the basis of that, had a little bit of a think about some of the things you might try and improve this year and the way that you've experienced or your experiences throughout the course of the previous year. What I'm going to do for today is, interestingly, I'm going to throw up a few things for discussion. I certainly invite your feedback, so if you could all have your hands on your keyboard ready to type in, certainly like to get some conversations going throughout today's webinar. All right, let's get underway and kick things off. As always, I do have to read the disclaimer. It's an ASIC regulation. The content of today's presentation or any other Elite Traders Club material for the rest of this year does not constitute a recommendation, nor does it take into account your investment objectives, your financial situation, nor particular needs. So, as always, before making an investing decision based on the general advice presented in any of the ETC presentations, you need to consider whether the advice is appropriate in light of your financial circumstances or seek further advice on its appropriateness. Today, what I'd like to go through is have a bit of a look at what happened in 2015. I'm certainly of the view that it's really important to discuss what we've learnt over a period of time. Now, for a number of you, some of you are new to the Elite Traders Club. Some of you have been part of the Elite Traders Club for 2-3 years. Some people even longer. And I think it's really important to have a very honest, open discussion about what's been happening in the markets and what's been happening with your own development as a investor, as a trader, over that length of time. So I think, given that it's a new year, I think it's important to have a bit of a look at, how did the trades that we examined last year and put into the watch list, how did they perform by both markets, so both the Australian and the US? And from that point of view, have a bit of a think about, what can we learn from the way that we've handled, any trades that we've been in. Have there been any weaknesses on our own part that has perhaps prevented us achieving, what our goals may be? Now, you might remember in your trading plans, hopefully, a well-documented trading plan that, you've started off with some goals. And for most, a long-term goal, trying to achieve somewhere around about 15% per annum is a fair and reasonable expectation. In some years, you're going to do much better than that. In other years, you're going to be scratching just to come out break even. I'd like to talk about some of that today as well. I've gone through at great lengths. It was the first day of work this time last week to have a look at both portfolios, so both watch lists, both the US and the Australian one, and to go through and have a look at each of those trades. So this was as of last Monday. Certainly a lot's happened since then, but just to take a snapshot of what would be the outcome if you're in a position where you're able to take every single trade. What would it look like in terms of the system's expectancy? Now remember, expectancy is just one way that you can measure the performance of a particular system, a particular methodology. And I think it's important to keep that in mind, and because from year to year, sometimes your expectancy is going to go up and go down, but it's really about an evolution, if you like, or building a historical perspective of what a system's expectancy is over differing types of markets. So we have bull markets, bear markets, sideways markets. We have bull markets with low volatility. We have bull markets with high volatility. We have sideways markets with low volatility and high volatility, and we have bear markets with low volatility and high volatility. So there's quite a number of different dynamics in the market, and that's why it's really important to continue to reflect on a system's expectancy. So 1 year's results doesn't necessarily reflect the future or the previous results that have been incurred by a particular system. So we'll go through and have a bit of a look at that. Certainly just want to touch on the benchmarks for this particular year, where we're currently at. Reflect on that a little bit, and again, invite your responses and have a look at any specific setups along the way. So first things first, let's go through and have a look at 2015, the year in review. So the first cab off the rank that I want to talk about is the Australian market. And I think it's important because a lot of us are trading the Australian market, and most investors out there, most retail clients, really that's their primary focus, is the Australian market. For a number of years we've been talking about the need to think outside the box and look at other markets that are potentially offering better returns, and for a long time that's been the US market. Not so much this last 12 months, however, and as you know, we've been saying that eventually all good things come to an end, and that's why it is very important when the going's good that you're putting hay in the hay shed. So we'll come back and talk about some of these themes. So this is a snapshot. This is at the end of last year, as of last Monday. Sat down, I had a bit of an email conversation with a couple of you about this in terms of what the watch list looked like. So you can see there on the screen that we had 21 losing trades and we had 20 winning trades. So all in, over the course of last year, there were 41 trades that made their way into the watch list. Now of those 41, pretty much 50-50 winning compared to losing. So a strike rate of around 50%. Strike rate of 50% is actually pretty good. In actual fact, there's a lot of systems that have quite low strike rates, but still are very profitable. The problems with those sorts of methodologies is that because the strike rates are quite low, it does take quite a degree of discipline for you to stay in those trades, because you're expecting, along the way, a lot of losers. And so a strike rate of 50% is actually is quite a good result. So of those trades, obviously, if we go through and have a look at some of the losing trades just initially. Now what I've done here is I've gone through and looked at the entry levels and the stop levels. Okay, so where we entered the trade and where we exited the trade eventually. And so we had our entry levels, we had our initial stop, and so what the risk was on the trade, so in terms of dollars, where the exit was, and then mapping the loss in terms of R, in terms of risk. So when we're placing a trade, we're typically, whatever that unit of risk is, we're calling 1R typically. Okay. So if we happen to get into a trade and the trade goes backwards from the word go and hits our protective stop, then we lose 1R. Okay, so one full unit of risk. So interesting to go through and have a look at the losses, and out of our 21 losing trades, go through and then come out with an average. What is our average loss on our losing trades? Now typically what you might expect is that because we're looking to trail stops along the way, hopefully that our average loss is going to be lower than 1R, okay? Which is kind of, what you would be hoping for, that, you don't have a whole lot of trades, that 50% of your trades that you just get triggered into and they turn around and automatically become losers, okay? Because again, if we think about the selection process for our trades, we're looking for stocks that have good relative strength and those that have been outperforming the markets in well-defined uptrends along the way. So theoretically, if the market has been showing that it's been liking those stocks, there should be a reasonable chance that quite a number of the stocks that we get into are at least going to move in the right direction at some point. Now going through all our losing trades, you can see down the bottom here that the average losing trade had a loss greater than 1R, which was really interesting, and that surprised me in going through the results. I was thinking more that, okay, our average loss, I think it's probably going to be less than 1R because we're going to be trailing some stops along the way. Interestingly, it didn't turn out that way, and that was largely due, if we go through and have a look at some of these, that whilst we had a few that were a little bit greater than 1R, we had a couple that were, getting towards 2R. ANZ, nearly at 1.8R. Another one down here, IPL, 1.8. PME, 1.6. So a couple of ones there really where, we lost more than we initially planned to. And that can happen through slippage, for announcements, all sorts of things along the way. But I think it's important to acknowledge the fact that that does happen, and it's just part and parcel of being in the markets. So first observation there, that our average loss was slightly greater than our initial 1R. On the other side of the ledger, we had 20 winning trades, and I think, again, really important to go through and have a look at some of these, the winning trades there. I'm not too sure why I've got a minus in there. Oh, that's right, because at the time, these are still open trades. So what I did as of this time last week, had a look at the stocks in the watch list and just assumed that every trade in the watch list that is currently open, that we closed every single trade just for the purpose of measuring what the actual return was, if you like, a snapshot at that moment in time. So as of last Monday, what the actual returns were. So GOZ was a trade that we're still in. Same with Sydney Airports as an example, and also HFA. So this time last week, those trades were a little bit underwater, and we were just saying, okay, if we closed out all our trades now, what would the result be? So that's why those negatives are there in the R column. So same sort of procedure that we went through: entry, the initial stop, so what the initial risk is in terms of dollars and cents. Assuming that we exited last week, what was the R multiple in terms of our wins? Okay, so as an example, Capilano Honey, an entry at 12.07, stop at 10.98, risking $1.09. Okay, so if that was 1 unit of risk, and we exited last Monday morning, and the stock was at 21.90, we would have a 9R result. So 9 times what our initial risk was. Okay, now I've just got a question for you, and I won't call out names or anything like that, but just of those stocks on the winning side, if you just type into your little chat window any of those stocks that you were in during the course of last year. So we've got CZZ, AIA, which is Auckland International Airports, ARB Corporation, BWP, GHC, GOZ, AHD. We've got a couple of entries in AHD, AOG, APE, BKL, which is Blackmores, BLA along the way there, CKF, which is the company that looks after Kentucky Fried Chicken and a few others, MVP, Domino's Pizza, FPH, which is Fisher & Paykel, SHV was Select Harvest, Sydney Airports, VOC, HFA. Thanks, Kay. Thanks for typing those in. Terrific. Thanks, guys, for putting some of your selections down there. So, again, it would be terrific if we could take all of these trades. Unfortunately, using our money management criteria that we have in our trading plans, it's really difficult to get much more than around about 10 trades in a portfolio, because you simply just run out of money. It's difficult to get your level of exposure that's actually in your trading plan, as I said, because you run out of money. So it would have been great, as an example, if you just, you might have a $100,000 portfolio, and you might say to yourself, well, if I bought myself $5,000 worth of each one of these, what would the end result be? Now, it actually wouldn't have been too bad a result, because your average win, if you like, is nearly getting towards 3 times what your average loss is. 20 trades, it would be great if you could pick all those 20 trades. Unfortunately, Murphy's Law suggests that if you pick 20, you're probably going to pick, 8 to 10 of the good ones, and you're going to pick 8 to 10 of the ones that don't turn out. The important thing is that once you're in those trades, that you manage them appropriately. Now, really interesting, I'm going through here and seeing the results of, what stocks everybody's been in along the over the course of the last 12 months. And interesting that some people have been just in US only, and the last few years the US has certainly been the stronger performing market. Not so much this year. Interesting that, and we'll get to the US in a moment, that by comparison the Australian trades with the US, I think you'll be quite surprised as to the overall results. So a number of you have along the way been in Capilano Honey, and the question there, the obvious question is, are you still in it? Because remember, our rules say we need to let our profits run, and it's really important along the way that you do that, because by letting your profits run and taking on a unit of risk, doing the right thing and being steadfast in a very simple to use trade management system is really important to getting the sort of expectancy or the R multiples over an extended period of time. So it's really very important that you stick to your guns and that you don't try and second guess things. Now, that's the hardest part for most people once they've got over the initial challenge of keeping their losses small. And I think most people, when they're through their development, the first obstacle is to get those losses small and make sure that they're not giving too much to the market. The next thing to do after that is to let the profits run. Now, in doing that, part of the changes over the last 8-9 months in particular has been, you might remember, the use of the price volume volatility signal. So when stocks are moving up and there's an opportunity, when the price volume volatility signal goes off, when there's an opportunity for you to bank some of that money, that is, remove it from the market, then that way you're eliminating that element of risk that the market can always throw up. I think that's important to acknowledge as well, because we have times like we had through August, at the end of August last year, where the market threw a bit of a wobbly there during one particular week. Now, if the opportunities arose prior to that time and you weren't able, or you didn't take any profit off the table when you had those signals, then through those sorts of those events, the market can end up taking a lot more out of your portfolio than you would have originally planned for. So I think it's important to acknowledge that aspect of it. The other aspect why I think that the price volume volatility signal is important is that it provides an opportunity for you to put money into your account, okay, taking it out of the market, and that has good psychological benefits, if you like. So it makes you feel a little bit better about what you're doing, the process that you're following, and if that's going to help encourage you to continue to follow your plan, then I think that's a positive thing. Okay, certainly looking for opportunities to add back in should the setup occur. At the very least, seeing some continued rising troughs along the way is always a positive sign at the very least. So things like Capilano, as an example there, opportunities along the way to take some part profits and then re-add a little bit along the way as well. So certainly a number of you have been in, I can see, have been in some really strong performing stocks over there. CZZ, AHD, Domino's Pizza, Sydney Airports as an example along the way. In fact, a number of you have been in a good selection of these. So hopefully you've been able to, get some positive benefits, because you look at some of these returns through here, and certainly, look, there's a couple of outliers. For example, how many of you may have been in Blackmores along the way, or missed it, or thought, gee, I can't get into Blackmores at $80. That's just way too high. And, a couple of weeks ago it was trading at around 217, 218 as an example. Who would have thought it could have gone that far? But again, it's just important that, we don't try and second guess the market and where these stocks can actually get to. So, I think it's important to acknowledge the trade management side of things along the way. So that's the Australian results over the last 12 months. A question at this point, again, I'll just invite you to type in on the keyboards. In terms of last year, those of you, and we'll get onto the US in a moment, in terms of the Australian market, what is it that you learnt about either yourself last year, or your methodology, or even perhaps your money management? What are some things last year that you learnt about either of those? So typically when we're talking about trading, we quite often talk about the 3 M's: methodology, money management, mindset. And quite often in the workshops, I'll go around and ask and say, look, which of those do you think is most important? And I think they're all important. Quite often talk about, the three-legged stool, that, if you're not strong in all three, then chances are that one of the legs of the stool is going to crumble and you're going to fall over. So I think from that point of view, having a bit of an understanding, a bit of a serious think about which element of either of those three, your money management, your mindset, or your understanding of the method, are you finding perhaps, it doesn't have to be the most difficult, but the more challenging aspect of it. So I've got a few bits of feedback there. So some saying needing to improve money management. Money management, it comes in different forms, doesn't it? So money management in terms of risk per trade is really important, and making sure that you're not having more risk on one trade than another. And that can come, and bite us on the backside sometimes. Murphy's alive and well in the markets, and sometimes that can be, look, I've got too much capital exposed on one position, and unfortunately that's the one that goes the wrong way, and the one that goes the right way was one that had too little capital on one, as an example. Interesting, a little bit of a mention there about round numbers. Some people, avoiding stocks because they're close to round numbers, and hopefully, over the last 7 or 8 months, you've seen that, round numbers don't make, in my mind and my experience, a significant impact on what's eventually going to happen to the trade over a period of time. Keeping in mind that, from this point of view, we're really thinking medium to longer term. So, i.e. managing self-managed super, those sorts of things, rather than sort of quick in and out bites that you might do in a shorter form of the methodology. Being careful, and if in doubt, stay out. Yep, absolutely, that's fine. If you can't find valid reasons for getting into a particular setup, then absolutely stay out. If you have to squint, or if you have to spend too much time looking at a setup, then it's really not there. Mindset was my weakest point, but has improved slowly. It's interesting. We very often don't put too much emphasis on mindset. We go, oh yes, you've got to be disciplined, you've got to do this, and it's very easy to talk about being disciplined, but it's very difficult to improve upon already established habits. If you're fearful in the market, then those sorts of emotions come through to the surface very quickly when the market starts to become quite volatile. And unfortunately, what that can mean for us is that we think, oh, the market looks like it's going to go down 20%. I've got some profit on this trader, I'm going to get out. And inadvertently, rather than sticking to our plan and saying, look, I've got stops in there, I've got my rules, but I don't trust my rules because I don't think my rules are going to get me out in time. And so by taking those trades off, what that all of a sudden does is it means that we never get to experience some of these bigger types of returns along the way. And so that's a really critical aspect, and I think that's important to acknowledge along the way. So thanks for that feedback on that. Consistency in putting in an hour or two to manage my portfolio. Okay, yeah, that's fine as well. Certainly we don't want your trading, your investing to be an onerous task. There's a lot of stats out there that talk about the average amount of time that somebody's spending on managing their self-managed super is up to in excess of 3 hours a week. Well, that's a game of golf. That's a long amount of time to be spending on your finances week in, week out. So we really don't want it to be, all-encompassing, because that takes away the, if you like, the satisfaction of doing it yourself. It becomes one of those things that is a drag, and we don't want it to be a drag along the way. The mindset again from another one. Better understanding of the method. Move to soft stops. Manage the trades with more discipline. Fantastic. Well done. Again, each of you is going to have your own opinion as to whether you like to use soft stops or hard stops. My personal preference is to use soft stops. I've discussed some of the advantages of using soft stops. But again, to be fair, there's also some disadvantages as well. And sometimes you can get significant moves against you. But that's just part and parcel of being in the market. And I think that's, again, where it's really important to make sure that you don't have, that you're on top of your money management, you don't have more exposure than what you're actually aware of. Sticking to the rules, yep, that's right. A passive investment portfolio. Now I'm going to use trading principles for everything. Okay, the 3 ATR rule certainly changed my perspective. Thanks, Peter. Staying with your stocks for yield outside. Interesting. I'm not too sure what you mean on that one there, Lindsay. Certainly, obviously, depending on where you're at with your self-managed super, as an example, a lot of people do rely upon yield and dividend stocks, etc., for producing income that they live off. Absolutely nothing the matter with that. At the end of the day, what you need to consider, and obviously there's capital gains tax implications and all those sorts of things, so I can't advise on that. Just have an awareness of where the stocks are heading, because your dividend yield, etc., along the way becomes a little bit superfluous if the stock happens to drop by 20 or 30%. That can be a fairly big chunk of your portfolio going down. And the one chart that you need to have a bit of a look at, I'm not suggesting that this is going to happen, but as an example, Japan went through many decades in a deflationary type of environment, and its market, for about 22 years just went down and down and down and down and down. And so that's one thing that capital protection is really important along the way. Another one there. I find it difficult when I have a stock that was better, but then drops back and goes out for a small profit. Yeah, absolutely. That can happen too. So you can end up being up quite nicely in a stock, only for it to turn around and you give back, a fair amount of that profit. And this was something, if ever any of you have read, done much reading, the Turtle Traders, this was something that the Turtles had to come to grips with. They'd have a number of trades, they'd have a number of small losses along the way, but they just had to manage the trades according to their rules, and they always found that even with their biggest trades, they always gave back a chunk of their profits along the way. But that's part and parcel of the trend following methodology. But if you keep doing it across the range of stocks, then you will have stocks in your portfolio that go on, and they might give, as an example, Blackmores at the moment there, you'll see on the screen a return of 13.5R. That trade's still open. Now, we don't know where that's going to finish. That might end up going as far as 25R, and you end up being closed out making a profit of 18R, and you think, well, I could have made 25R, and we berate ourselves for making only 18. Again, We've made a truckload of money on a result like that, and yet we feel the negative side that we didn't yield as much as we could have, and that's just part and parcel of understanding what's happening in the markets, and growing a portfolio. You're never going to get out of the top, and that's why again, taking some profits along the way, I think, is helpful to capture some of those bigger moves before they turn around and stop you out for a smaller gain. So hopefully that makes sense. We've spent a fair bit of time there just in some of those discussions, and those discussions equate or are equally as valid for the US market as well. Let's go through, while we're doing that, let's have a look at the US. So, just to recap here, 41 trades, 20 winners, 21 losers, average win 2.83 R, average loss a little bit greater than 1 R, expectancy of 0.84. So that means for every dollar of risk, that in terms of expectancy, you are expecting to return that $1 that you risked plus 84 cents. So that's a very good measure of performance for that particular year. Okay. And just some assumptions down there as well. So the results don't include any dividends. So some of those stocks absolutely give some quite nice dividends along the way. So hopefully you've been able to benefit from those as well. And all trades in the watch list considered to be closed as of Monday last week. Okay, so obviously would have changed a little bit over the course of this last week that we've just had. So in the US, how do we go? How did the watch list perform? Interestingly, 186 trades last year in the US watch list, 106 losing trades, 80 winning trades. So for a long time we've been talking about how the US market has performed really, really well. And the last year, and we'll have a look beyond charts in a moment, to have a look at what's happened with the overall, the benchmark indices over there. And you'll look at that and you'll say, well, no wonder it was a difficult year. The market really didn't do anything last year except go sideways and have some really excessive periods of volatility. Very difficult market last year, the US market, by comparison with the Australian market. Certainly a bigger market, a lot more trades over there. Interesting again. If we go through, and I couldn't fit these all on one page, so I'm going to go through 4 slides here, and I just want you to have a bit of a look at a couple of figures: the average loss, so the loss in R, and the wins in R. Okay, so we'll go through each. These are all the stocks throughout the entire watch list, and again, I won't go through and ask which ones you're in because the list here is a little bit long. But certainly in terms of the R on the right-hand side, we really didn't have too many trades that went on to make significant profits. Okay, so we didn't get a lot that made it much past, sort of 2 or 3 R in overall result. One at the bottom there, HCC, making nearly 7 R. But other than that, the average return in terms of R was 1.23. So that's pretty low considering that's out of 80 winning trades. Now you'll see on the left-hand side that we've still got another page and a half of losing trades. So we had 106 losing trades. Interesting that the average loss was 0.87 or nearly 0.9 R. That's a smaller average loss than we experienced in the Australian watch list. Now I didn't expect that because the stocks in the US are generally a lot more volatile because we've got earnings announcements coming out 4 times a year instead of 2, and we had those big bouts of volatility as well. And we had things like the Fed, aren't they going to raise interest rates? We had things in China occurring, Europe, etc. And I was really expecting that the average loss might be greater, certainly than in the Australian market. So that was something that was a little bit different. In terms of overall trades, as I said, a lot more losses than there were wins. Only 80 wins compared to 106 losses. So it's exactly the same methodology, but different results. Any comments? Some of you, earlier had been trading the US market, solely as opposed to the Australian market. If we go through there, the comparing the two, 186 trades, 80 winning, 106 losing, average win of 1.23 R. So that compares with the Australian market where we had, getting closer to 3R for the average return. Average loss 0.87, so less than 1R, and that compares with the Australian market where we had a little bit greater than 1R as the average loss. Big difference, however, is the expectancy. Expectancy of 0.03. That is marginal at best. Okay. So what that means is, if you have $1 of risk, you're expecting to, from that, return that $1 of risk and make 3 cents. Okay, that's really, from that point of view, you're not going to make money using a system like that has those sorts of results on an ongoing period. And this is why you need to contextualize this and think about it in terms of, a longer term strategy, because your trend following will work over an extended period of time when the markets trend. Okay, but when they don't, you're going to find that the methodology slows down. It doesn't work as well as it should. Okay, some feedback there. Thanks for doing the reviews. That's no problem at all there, Ken. A couple other guys saying just managed to break even for the year in the US. Fantastic. I mean, if you've managed to break even for the year and you've been involved in a number of trades, you've actually done pretty well. Certainly, the bouts of volatility that we've had during the course of the year there have made it very, very challenging to say the least. And as I say, in the markets, you're not going to make money every single year. It's just, that's just fact. But I think it's important that you acknowledge that along the way and certainly put it into context. So yeah, okay. So thanks to that, Kim. Just a bit of feedback there. So if you've in either of the markets, in fact, if you've come out, you're at least square, and you've had all your commissions and things like that along the way, then that's a positive outcome, really. Hopefully, during the course of last year, those of you perhaps in the Australian market, hopefully you've been able to make a little bit of money during the course of last year through hanging on to those stocks, not panicking, not bailing out too soon, and potentially collecting some dividends along the way as well. So again, I've talked about that for a fair length of time, but I do think it is important to acknowledge what has gone on in the last 12-month period. All right, any further questions, comments, observations along the way? I've just put down a few there. Obviously, the average loss in the US less than 1R. Average win in the US 1.5 times larger than the average loss. It compares with the Australian market there. Average loss in the Australian market just a little bit greater than 1R. The average win 2.8 times larger than the average loss. The strike rate between the two. The strike rate in the US of 0.43, so 43% of the time we had winning trades. In the Australian market, closer to 50%. So the combination of a higher strike rate plus a higher R multiple in terms of average wins has meant that the Australian trend following for this particular year has yielded a much higher expectancy than the US. Same system, different markets, that's all. I think it's important to acknowledge the two. Don't throw out the what's the saying? Don't throw out the baby with the bathwater. All right, so what we might do now is go through and have a bit of a look at what's been happening on the markets for the time being. So the Australian market in very high market risk mode at this particular point in time. The S&P 1500 in moderate market risk. So let's perhaps go through and have a bit of a look at beyond charts. So I'll just bring up that now and just have a look at the indices over the last 12 months. So I've just put in here this little profit and loss line. So this is the beginning of last year to where we closed on Friday. Now the market's opening this morning. They were going to open down a little bit above 4,900, around about 49.25 the last time I looked. So, you know, where we are now from where we started last year, down, getting close to 8%. So by the time you put in some account for some dividends, etc., you're still going to end up, you know, below break even, if you like, just through, you know, market moving to the downward side. Interesting, again, just some observations. You know, our benchmark indicator, our stochastic, below 60 there, and I'm probably a little bit of a broken record, but I think it's important, particularly for the newer members. And once we get below that 60 level, the propensity for the market to fall away quite quickly does tend to increase. At that time, you'll see that the volatility, so that's just the directional movement, either upwards or downwards, for a period of time was fairly low. It was lower than you know, its average over a look-back period of around about 63 periods. Then as market risk started to deteriorate, you'll notice that the volatility, the upwards and downwards movement, started to increase along the way as well. And certainly, you know, this is sort of around the end of August time, you'll see, you know, big spike in volatility and remaining quite volatile for a period of time whilst we were in much higher risk mode. So certainly through here, this is where a lot of profits were given back along the way, a lot of stop outs, etc. Volatility then did start to reduce a little bit. Certainly now it's just starting to increase again. And last week, you know, over the course of the last couple of weeks, certainly some trades in the watch list being stopped out. Compare that with the US, and as beyond charts just turns over to the next page as it brings up the S&P 1500 sometime soon. Okie dokie. Come on, beyond charts. I know you can do it. I'll bring it up in a moment. Interesting exercise to go through and just, there we go. So we've brought up the S&P 1500. Same sort of thing. Beginning of the year, this is where we are now. So overall movement is pretty similar. You know, down around sort of 7% from, you know, the beginning of 2015 to where we are now. You know, very little dividends in the US market. Huge volatility. You'll see, you know, August, September period of time, volatility reducing, now starting to increase again. You'll notice again, we're getting below 60. We had volatility starting to increase, and then we had that big move to the downward side. Interesting that we made it back up into lower risk markets, sort of in moderate market risk. In fact, we're below moderate now, so I'll have to update that. We're below 60 on the stochastic there, so that's just happened in the last few days. What I'll also show you, just for a bit of context, a bit of perspective, is I'll just bring up some analyses along the way. So I've just done some monthly analysis, and the main observation here, and something I like to use in terms of a broad bull market, bear market indicator, and I've discussed this before, particularly during some of the education sessions, if you've had the chance to catch up on any of those, is that a good bull market, bear market indicator is just a 10-period EMA on a monthly chart. Okay, so when price is above that, we're typically in bull market territory. When price is below it, we're typically in bear market. So one of the ways that you can really sort of simplify this is just use a slightly shorter term moving average, for example, a 6-period moving average, again on a monthly chart. And when the red, the shorter period, is above the blue, we're in bull market territory. When it's below, we're in bear market. Okay, so just a very simple way. If you're ever in doubt about what the market's doing, have a look at a longer term point of view, so a monthly chart, and just see, is the red line above the blue or not? And you'll see periods where we're clearly in bull markets, clearly in bear markets. And it does provide a nice little insight into what's happening in the markets during particular periods of time. And so at this point now, where are we? Well, you'll see in the US, how long we've been in this really nice bull market. So, particularly since around the middle of 2012, we had a couple of years of very, very strong directional movement. The last period, the last 12 months, however, we've really, in terms of direction, as I've shown you, we've pretty much gone sideways. And you'll see at the moment that our moving averages are right on top of each other. So, the question is, are they going to do this type of thing and, spend the rest of the year in a downward movement like we've had before? Interesting to note, the length of these bull market runs is largely quite similar. The length of these bear markets are quite similar as well. Now, I don't know what's going to happen in the future, but certainly we're at a pretty critical juncture at this point in time. Now, the question that I think is really important is, if the market rolls over, and certainly the Australian market has already rolled over, but if the US market rolls over and we do enter this type of environment, what does that mean for long-only portfolios? Well, first of all, it's going to mean that it's going to be a lot more difficult to make money against the tide. So from that point of view, if the market's doing this, where's the safest spot for your hard-earned capital? Should you be looking to place lots of trades in the market, or should you be looking to preserve, waiting that we've got clear evidence that we've hit a bottom, if this is going to be the case, before we start to look putting capital back into the market? So that's one thing for consideration. The other aspect of it, remembering from your trading plan, is that a number of you actually have two trading plans. Some of you will have a short-term trading plan, some of you will have a long-term trading plan. So in terms of capital allocation, a question for you while I have a drink of water: what portion of your capital, if you were going to do short-term trading, would you allocate to short-term? So we all know how much we're allocating to a longer-term portfolio. What percentage of your capital, if you were going to do short-term trading, is prudent to allocate to a short-term trading strategy? I'll just have a drink. Okay, thanks for that feedback there, Ken. Just wait for a couple of others to type in along the way. All right, typically in terms of allocation of money, your account to the short term, typically we, what's the right word? We don't advise, we don't recommend, suggest perhaps, with caveats, etc. I mean, at the end of the day, it's your money. You can do what you like. From a short-term strategy, though, considering your entire amount of capital, risking only around 5% up to a maximum of 10% of your overall capital is suggested for a short-term trading strategy. Okay. Now, again, you all have your own individual risk profiles along the way, but if you had $100,000 in your overall trading account, then really 90,000 of that, 95,000 should be allocated to the longer term, and only around 5,000 to a shorter term style of trading. So with that as a backdrop, one of the things I'm considering for this particular year as it proceeds is that, in these sorts of markets, it's going to be difficult to make money on the upside in longer term portfolios. Not to say that you won't make money, because we're never too sure what the market's going to do. What I'm proposing is that with the short-term style of trading, running a once a week short-term analysis session. Okay, so I know in the past where when we've done short-term analysis sessions, they've been every single night basically. And if I've privy to all the results of the watch lists over the last few years, and I can absolutely tell you with my hand on my heart that the short-term trading strategy does not make money. By the time you take into the consideration your costs, etc., along the way, the results, the expectancy is absolutely marginal. The volatility is huge, and I don't think it's something that you want to be allocating excessive amounts of capital. So that 5 to 10% certainly makes a lot of sense. So with that in mind, just a question for you. If you can just type in a yes or a no. Would you like me to do a once a week short-term analysis session? So it would be using daily charts. It would be, again, it would only be once a week. I'm not going to commit to doing it every single day. It's just too much. It's too much work to maintain a watch list. I don't really have the time to do it, and certainly if the results over the last 3 or 4 years had overwhelmingly proved that it was worthwhile doing, then absolutely I'd change my mind on that. But certainly I think a once a week look at the the setups, etc., for discussion purposes, and at least that way those of you who have a penchant for the short-term style of trading would get some value out of that, because I don't want to ignore the fact that you can actually make good money in bear markets. It's just that it's much higher risk, and I don't think it's the right thing to be pushing for people who are are trying to accumulate wealth in a longer term style of investing, if that makes sense. So. All right, so a lot of good feedback there coming through. Thanks very much, everyone, for giving me your opinions, etc. I do want to make sure that you still get value out of the Elite Traders Club. Particularly if we get some of these markets like this, then I think there's the opportunity to make a little bit of money along the way. But as I said, you're going to be faced with lots of volatility. Now, volatility is it's a bit of a double-edged sword. It can work for you, it can work against you. Unfortunately, some of our biggest up days and biggest up weeks are during bear markets. So you've got to take that on board as well, and that's why it's really important that if you're going to do any short-term style of trading, and really in terms of this, I'm really talking about short term as also in terms of directional. So from that point of view, being short as an example, there are certainly dangers to going short. There's a story recently of a chap in the US, and I think a lot of the what we talk about anyway in ETC would have saved this gentleman from now becoming a slave to his broker. A chap who had shorted a stock at around about $3. The thing had been going down from, I think, around about $50 or whatever. Thought that that was a good idea to short it because he was expecting the thing to go to zero. Unfortunately, what can happen with stocks as their price gets closer and closer to zero, if you like, is that in this particular situation, the company became attractive for a takeover. And over in the US, they don't have CFDs. So when you go short as a US citizen over there, you actually short the stock. So you borrow the stock, you sell it. Unfortunately, this particular chap did that. He did that with his entire account. He had a net position of about $30,000 short. Announcement came out, the price gapped up to somewhere around about $25, and he now owes his broker a truckload of money. I think he actually sent himself up one of those crowdfunding accounts, explained to everybody what he did, but as yet hasn't raised any money. So there are certain dangers of shorting. So I just need you to be aware of that as well along the way. Kim says turtle trading strategy uses both directions. Yes, that's right. Is there any work being done on long, medium? Oh, okay. Any longer term, medium term, short setups? Certainly, you can do that. You can certainly run weekly short setups, and so those of you who are interested in looking for sort of more medium term short trades, if you like, trades to the downward side, I can help you with Beyond Charts and just configuring a couple of very simple scans, just changing the periodicity, etc. Along the way as well. But certainly, if I do some short-term stuff, it'll just be using some daily charts along the way, just to as a point of interest, and for those of you who are looking to perhaps engage a little bit on the short, that is the downward directional type of movement. All right, folks, that's what the markets is doing at the moment. In terms of scans, I ran a scan over the weekend. That's the result. It went through, it scanned 2,700 of 2,700 stocks. This is a US weekly scan with all the relative strength parameters, all the trends in alignment, also looking for a short-term uptrend at the other end, and it came up with one, which was, I've never seen that before. It's always come up with more than one. That's the actual setup there. So if I just put on the USA overlay, it actually doesn't look too bad. It's got some relative strength coming through recently. It's just put in a nice high trough. We would just need to ask the question, well, where are there any points of overhead supply? Quite clearly, there's one just there, which we've gone through. However, a little bit further up, there's another one there as well. So that certainly prevents us from looking at that one as a trading opportunity. In the Australian market the last week, there were two stocks that came through. One of them, CKF, surprisingly, but been performing really very, very strongly. This is one that we entered a little while ago and has moved up. Had some reporting news that came through and drove that share price up nice and high. This is also one that was in Jeff's Elite Investors Club. Jeff and I work pretty closely together, and we're going to be working a lot closer together this year as well, because I think there's certainly a lot of merit in using some technicals with some fundamental background as well. And a lot of Jeff's best performing trades, there was opportunity to get into those on some good technicals. And not always at the time when Jeff has done his analysis, but there are certainly some key metrics that you can use to help with your timing of entry into some of Jeff's tips. Now, I know not all of you are in the Elite Investors Club. That doesn't matter, because I'll be bringing some of those fundamental based stocks that we both like. He'll like from an investing point of view, fundamental point of view, but I'll certainly like from a technical point of view. And though they're ones that if they don't come up on the ETC scans, I'll certainly be letting you know along the way, because I certainly think there's value in doing that. Okay, so let's have a look at the setup on this one here. So I'll just bring up, I think it was this one. Yep, there we go. So again, this stock has passed its previous peak. Now remember, we said it's okay to still get into a stock once it's passed its previous medium-term peak. In this particular case, it's moved a fair way past. So if you were going to enter this particular stock, first of all, you need to accept that it's going to have a much wider protective stop, because your protective stop needs to be below the last medium-term trough, at least 0.5%. Now, if you do that and you put a non-stop order, remember 0.5% above the that point of supply, that last candle, then it has an entry point there. You can see non-stop order of $5.14, and your protective stop below that last medium-term trough is at 407. That's a 20% stop loss. Now that's obviously pretty wide. You just need to adjust your position sizing to make sure that you would only be risking your normal 1 unit of risk on that particular trade. Certainly, as the trading range has expanded, an increase in volatility, it still represents, if you like, a unit of risk, whatever that is for you. So that's something that certainly relative strength-wise, it's been very, very strong, CKF. And the other one that came up was Elders. Now this was actually a setup of a couple of weeks ago, but because we weren't online the previous week, certainly it's a setup that you could easily have traded on the breakout of this last medium-term peak through here. Price action, last trough at or above second from last medium-term peak. Now if you scroll out, what you will see up at this green line is a long-term peak from a number of years ago. Those of you who've been in the market for a while would know about Elders, particularly those of you who are Victorian, with John Elliott, etc. In earlier years. This is a stock that was in excess of $100 a number of years ago, and it's been since all that time being beaten down. They've had a lot of changes, etc. occurring, and this is actually one of Jeff Saffer's favourite stocks for a longer term play. Now the only thing at the moment, if you were looking to get into this prior to last week's candle, you had plenty of opportunity for at least 2 to 1 into this longer term peak. At the moment, in terms of getting into that, if you're getting in just above $5 and you've got a protective stop around about the 417 level, you've just got a little bit too much risk in terms of reward to get you 2 to 1. That's all for that one. So just something to be aware of on that one there with Elders. Some comments coming through there. Have taken half profits. Okay, so on which stock was that, Ken? I think you're probably talking about CKF. Yep, fantastic. So let's just go back to CKF, and you'll see we've had some price volume volatility signals going off there, thinking about what the initial risk is on the trade. Are we up 2 to 1 at those particular levels? Absolutely. And so taking half off there at that particular point in time, first of all, it puts some money in your account, makes you feel a little bit better about what you're doing. At the same time, is going to encourage you to stick to your trading plan. Your trailing stop up at 407 at this particular point in time, re-adding to a position, you could certainly add in on a break of that particular level. Look, certainly if price gets up there during the course of this week when the rest of the market looks pretty dour at this point in time, certainly reinforces terrific relative strength. The US market, world markets have come down pretty heavily in the last week. They're probably due for a bit of a bounce at some particular stage. So certainly that's a stock that's been behaving really quite well. All right, in case says got into Elders at 478, so on a breakthrough of that last medium term peak there, that's fine. The price action was very, very good. Certainly, just placing an on-stop order there, expecting that price is going to move up in that particular direction, and it did during the course of last week. So again, different ways to get into a trade. Really importantly, key elements there: relative strength, good price action along the way. The important thing is now, once you're in it, what are you going to do? Stick with your trading plan. Don't try and second guess what's going to happen in the market, and that's really the key to to trade management over the longer term. All right, folks, I'm acutely aware of where we are in terms of time at the moment. You've all been very good in terms of diligent and staying around, so hopefully you've got something out of today in terms of how things are going, a little bit of context about where the market is at this point in time in relation to the last 12 months in particular. Those of you who've traded the US, it's certainly been very difficult last year. Surprisingly, even though our market performed worse than the US, the portfolio performed better than the US. So again, certainly at the end of the day, you do have to have a little bit of luck. Luck does play a little bit. It does have an impact on, the outcome of your strategies, but along the way, the luck in terms of which ones end up in your portfolio, the key element is what you do when you've got those stocks in your portfolio, because you don't know which ones are going to go on and become, the Ramsays of the past, or the Blackmores, or the CKFs, or whatever. So again, stick to your guns. Have faith that if you do the right thing, that over the longer term, that your portfolio is going to grow. Right, folks, that's it. Just a quick heads up. I've got a week in Bali next week. There won't be an ETC session next Monday. I'm returning the following Sunday, so I'll send out invites and things like that. So there will be one the following Monday, but not this coming Monday. I'll send out the invites for that. So in the meantime, if you've got any questions or anything like that, give me a call on the phone, or alternatively, shoot me an email. I'd love to catch up and have a chat. Right, folks, we will see you again live on air this time in 2 weeks. All the best in the meantime. Bye.